So, thanks for joining us. This is the fourth in our series of pension and divorce webinars. Today's session is on pension valuations. When is the value, not the value? And just before I start, just a couple of housekeeping points. First of all, I'd like to thank Rob and Mike for joining me today as facilitators. They will be keeping an eye on the chat box as I go through the webinar. And at the end, we'll put in the chat box a web link to a survey, which would be grateful if you would complete. So if you have any questions, please put them in the chat box, and Rob or Mike will be attending to them. We've also been asked to leave the webinar open at the end for the trail of questions which inevitably come from sessions like this. So we will keep the session open until it dies naturally. After this webinar, you'll be sent a copy of the slides that I'm going through, and also a recording. So if you haven't got time to listen to it fully today, you can listen to it again. So I think that's the housekeeping stuff out the way with. So the agenda today is I guess this is a list of things I hope that we're going to get covered today. First is I'm just going to run through the different types of pensions and how values are calculated with each different scheme. I'll also cover when you do and when you don't need a valuation, and hints and tips on how to get those valuations in an accurate and timely manner. And when you get the valuation, is it correct? What does it mean? What should you do with it, etc. And I'll be also covering the reasonably hotly debated issue of is asking for a fair value of any use or not. And also I'll be covering whether you share capital values of the scheme or focus on creating equality of income. And finally, what I hope you will get from this is understanding the key dates for getting valuations and implementing the correct valuation. So all that hopefully will happen over the next 40 minutes of this webinar. And just to slide in one slide about Blue Sky, for those of you who are new to these sessions, Blue Sky are a firm of chartered financial planners. We specialize in pension on divorce work, and we've been doing this for 20 years. And this type of work starts generally, as you probably well know, with a letter of instruction or indeed a case discussion that you will have had with us, where we may have assisted you in putting the right questions in your letter of instruction. Of course, that will manifest itself into a pension sharing report, typically, or the pension sharing report will be a single joint expert, or indeed we do an increasing amount of shadow expert work where you may have already got a actuarial report and need it deciphering, or you may not have decided that you want one, but you want some financial assistance with your client on finding their way through sharing the finances on divorce. And I believe our USP is that we create understandable pension sharing reports which don't have loads of jargon in, gets to the answer pretty quickly. And that's certainly the feedback that we have. And the final stage in the work that we do in this area is, of course, the implementation of the pension share once it's agreed. And that would be typically finding the right home for the pension share that has been awarded, and working with either client to help rebuild their finances, and certainly answer the question which a lot of clients will ask after they've been through divorces: well, how will my financial future look now I'm the other side? And if you need to talk to anybody, then the guys there are the Blue Skies financial planners. And if you wish to ask any questions, then pick the phone up. You'll be put through to one of those individuals, or indeed any of our technical team who will answer the phone when going through when you phone up. So just to help you, just to put all this in context, and this might be teaching some of you what you already know, but this is how different types of pension schemes are valued, and we'll start with probably the most simple types of scheme, which are defined contribution schemes, which are uh, uh, like personal pension plans. I'll use a bit of jargon there because that's the term that's used. So defined contribution schemes, and what these are of course individual funds of money that that are owned by the pension member. Those funds are built from individual contributions, employer contributions, tax relief, and indeed possibly a transfer in from a previous pension scheme or perhaps even a pension share. And once the money's in there, it'll be invested typically, and therefore the valuation of that pension fund will be the number of units, invested units in that fund times the price per unit, and indeed plus cash if there's any cash in that scheme. And this is how a defined contribution valuation statement might look. This is typical of many. This is a legal and general pension statement, and what you can see here is the number of units, the unit price, and the total value. And certainly with modern day pensions, the CE is the value. The value is the CE. It works that way. There's a couple of anomalies which I'll come on to, but in general, what you see is what the value is. If I move on to defined benefit schemes, which are perhaps more complex in nature, defined benefit schemes will be a scheme run by an employer, and the members will be members of the pension fund pool, if you like. They won't have their own defined pot of money. That pension fund is built mainly by contributions from the employer, and the employer's role is to make sure that that fund is large enough to provide the pension benefits to its members. And in general, the pension benefits from a defined benefit scheme are based on the year's service that a member has served in that scheme and their salary. Now, there's hybrid versions of that, but in the main, that's how pension benefits for a defined benefit scheme arise. And of course, the employer will generally be the major contributor. The employee may be asked to make small contributions, which in general are a very small proportion of the overall cost of their membership. So if we have a member who wants to leave that scheme and or there's a pension share which that member needs to deal with, then actually their membership of that fund will be a tiny corner of it, and that little chunk will come out, and that will be the valuation of that member's benefits, which could be transferred to another nominated scheme. Those benefits are valued by the scheme actuaries. No scheme actuary values their scheme in quite the same way, so there is no real guiding principle. I suppose there are general guiding principles, which are, well, what pension benefits has that individual member got, and what do the scheme actuaries deem its value to be. It will be based on that member's age and the assumptions that the actuary make, which will include the makeup of the pension fund membership, including their age, mortality, and the investment assumptions that actuary uses. So that bit is quite a dark art, and very few actuaries actually disclose how they work out the scheme values. And an example of a defined benefit scheme, sometimes they're quite hard to spot. In this example, it's pretty obvious because it actually says here your defined benefit transfer value. But what you will find will often be quoted is the period of service, so when a member joined and left, because remember, the benefits will be based on length of service. And this is the pension that they've accrued in this particular scheme between when their membership joined and finished. And if you wanted to get a bit forensic about this, you could check periods of service. So sometimes some cases we're asked to comment on whether we think there's anything missing. Well, it's a bit like a CV, I guess, in the sense that you try and tie up joining and leaving membership dates to piece their history together. The other thing worthy of note is sometimes it's quite challenging to work out whether the pension value, which this statement quotes, is the value that they'd accrued when they left service, or the value which has been indexed to today's date. And sometimes that's quite a challenge, and of course will make a big difference if you've got a statement that says, well, their pension that they had accrued when they left in 1975 is X. Well, of course, indexed to today will be a much bigger figure, so we have to be mindful of that. And there's a bit of a dark art here on sometimes people refer to the multiple or the pension to CE ratio as a very rough check, and it's a dangerous thing to look at because there's a wide variation. But in this instance, the value, that 559,000, is about 35 times the pension. As a rule of thumb, and the experience we have of those multiples is anywhere from 10 times, where the value, the CE, is 10 times a pension, which is obviously a very low value, all the way up to 70 times. So you can see in this instance 35 times is about middle of the road. It is a rough benchmark that we might look at and look for reasons why they might deviate significantly from that perhaps 25 to 35 multiple. If we whiz back to defined contribution schemes, personal pension type schemes, and talk about checking the values, then obviously we're looking to have a valuation date as recent as possible. We'd also look what's under the bonnet, because what you'll often find is that there are non-standard funds, and the problem with non-standard funds primarily is that they may not be liquid. And a good example of that in recent times is a lot of pension funds in recent months have had their trading ceased. So of course, if you're looking to share a pension that has illiquid funds within it, that can cause some issues. I'm going to give an example in a moment of a SIP, but SIPs and SASs. So SIP stands for sorry for the jargon, but self-invested personal pensions is a SIP, and small self-administered scheme is a SAS. You don't see many SASs anymore, but you see quite a lot of SIPs, self-invested schemes. And the reason why people often take out SIPs is because they want to put weird things inside them, which might include things like commercial property, and I'll come on to an example of that in a while. Of course, if you're getting a defined contribution schemes which has an investment element in it, you might be mindful of market movements, and some clients in particular are concerned about when the valuation was done. But of course, and I'll explain this a bit more in a while, if of course you're implementing a pension share when the markets are low, if it's done quickly, then you are buying in to the new pension fund at a low ebb as well. And the same is true that if you are administering a pension share when the markets are high, you'll be hopefully buying into the recipient's pension fund at a high as well. So generally these things work their way through, especially if these schemes are implemented quickly. Things to watch for. I'm going to talk about guaranteed annuity rates in a minute and explain those a bit more, but we've got guaranteed annuity rates, and certainly with a lot of older funds where there were, let's say, with profit funds, a lot of with profit funds in the past had guaranteed growth rates, and that can affect the way certainly that we will do a pension share. And the other thing is attaching benefits. And of course, this is what your pension on divorce experts should be looking for and highlighting. But in many cases, it might be attaching benefits to a pension like life cover or something which is called waiver of premium. And of course, those benefits will be lost if they're shared. So talking about guaranteed annuity rates, guaranteed annuity rates come from policies that contractually promise an annuity rate at retirement. And generally these policies were sold, if you like, in the perhaps 70s, 80s or 90s as a way of encouraging people to take policies out with companies such as Equitable Life, and those rates are quite attractive in today's terms, as I'll show in a bit. And these contracts were sometimes, not always, but sometimes known as retirement annuity contracts or Section 226 policies. Those were the self-employed personal pensions of the day. And just to give an example, Royal London, for example, used to offer guaranteed annuity rates in its pensions. And this is an example of a Royal London guaranteed annuity rate, 10.88%. Do note that this was a level annuity. So this was a pension, a payment that in this instance would, at age 65, if you opted to take the guaranteed annuity, then you would have a level income of £21,000. To put that into context, current level annuity rates for a 65-year-old, 4.71%. That compares with a 10.88%. So you can see that the guaranteed annuity rate is quite generous. And if you wanted to get an income in today of £21,000 on a level basis, it would cost you 462,000. Now I'm going to come on to the basis of true values and that stuff. But what you've got here is a Royal London pension which is worth £200,000. That's what you would be sharing if there was a sharing order on this scheme. But underlying that, the true value, if you like, of buying the same benefits would be 462,000. So quite a difference. We'll come on to how you deal with that in a moment. Just talking through SIPs, and in this instance, this is a self-invested personal pension. As I've already said, these schemes are built from contributions and transfers in. However, in this instance, in my example here, we've also got a business premises which the director has bought into his pension scheme. And in that instance, even though it's the director's factory in inverted commas. The director or his business will have to pay a market rate into that pension fund, and therefore what you might well find in a SIP which has a property in it, you might find a reasonable amount of cash which has arisen from rental payments, as well as investments and as well as a property. And I'll come on to the an issue in a moment, which of course revolves around the liquidity of selling a property that is within a SIP. On a very slight tangent, something to consider when you're talking about valuations and how they might change is that is to be aware that if we are doing a pension sharing report and we've got a valuation and from the scheme where the member isn't taking benefits yet, that valuation will change if the member starts taking benefits, because the basis on which the actuaries perform their valuation calculations quite often differs from pre and post retirement. And that, of course, can skew the figures and lead to unintended results. And the remedy there is to make sure that if a member is at retirement age, that they give an undertaking that they won't start drawing benefits until the pension share has been agreed and implemented. It's also worthwhile mentioning about particularly DB schemes, defined benefit final salary schemes, which are in payment. Of course, if you think it through, it's fairly obvious that that valuation will reduce over time because the scheme is now in payment and it's going to be in payment for a defined period of time, that i.e. until the member dies. There's a good reason there to implement pretty quickly. And of course, there is this issue of member payback, where if the implementation takes too long and the member has been getting their pension payments when in fact they should have been a lesser pension because the scheme should have been shared, quite often the member will be asked for a refund of some of his pension payments, because indeed they should have gone to the spouse and not the member. So there's two ways I suppose you can deal with that. One is to raise awareness that this is invariably going to happen with a scheme in payment. And secondly, is to make sure that the scheme is implemented quickly. And I know this, and I know I would say this, but of course, if you do go back to to someone like Blue Sky, who may have produced a pension sharing report, they may well be in an ideal position to implement quickly because they've got all the scheme details. They know what they are and how to implement those quickly. If I move on to a worked example, which hopefully will bring some of this information together, and I'm going to talk through the the constituent parts of these two husband and wife's pensions that they have. I'm going to mention a SIP again. This is a SIP ran by a company called AJ Bell, and this SIP happens to be worth £1 million. Importantly, inside that SIP is a 400,000 property, which happens to be the offices from which the husband works as a director of his business. And just to give you an idea, £1 million pension could provide a pension of £27,500 on an index basis. That's just applying a standard annuity rate. And I'll come back to that. But that's the first scheme. The second scheme is a Scottish Widows scheme. This Scottish Widows scheme has a guaranteed annuity rate. Value of it is 200,000. The guaranteed annuity rate would mean that this member will get a pension of 19,600. He also has a John Lewis scheme. Value is 300,000. paying £12,000 per annum as an indexed income, and I've included the state pension in here just for completeness, and also just to remind people that these days state pensions aren't shareable, but of course we would always recommend that state pension benefits are included in our calculation. If I move on to the wife, the wife has a teacher's pension scheme and a state pension. The teacher's pension scheme is that's the value, and that's the pension that is payable. And if you add it all up, what you can obviously see is there's quite a difference in income. So we immediately know the direction of travel is going to be somewhere from the husband's pension to the wife's pension. It's also worth noting there's a vast difference in capital value, but I'll come back to that and the meaning of that, or the usefulness or relevance of that. So if we then say, well, let's just think about the values of those schemes, and what the true values might be. And as I mentioned before, this Scottish Widows scheme has a guaranteed annuity rate that it's going to pay, and this John Lewis scheme is the other scheme I want to look at, because what we're kind of pondering is the value a representative of the income which is going to be paid. I haven't worried too much about the SIP, because the SIP value is £1 million, and that's what it is, and you apply an annuity rate and that's what you get. Now, if we look at true values, then the true value of the Scottish Widows scheme, if you what I mean by that is, if you went onto the open market and wanted to buy an annuity that gave you £19,600 on a level basis, it would cost you £416,000. And in a similar method, the John Lewis scheme, it would cost you £435,000 to get a £12,000 income. And remember, the difference between those two is that one's a level income, one's an indexed income. So this John Lewis true value is more because it's got to buy an indexed income. The point here is that both these schemes, I hope I've demonstrated that they are, if you like, I should have put this in inverted commas, they are undervalued based on how much money you'd need if you wanted to buy the same benefits on the open market through an annuity. So what we know as pension on divorce experts is that we've got to be mindful about which of these schemes to share if we need to. And what I would hope is fairly apparent is that the John Lewis scheme, although it's undervalued, it's not as badly undervalued as the Scottish Widows scheme. So if we need to share any of these schemes, we're probably going to pick off the John Lewis one first. So one of the points I want to get to is that true values are really only of academic interest. They are of relevance to the pension on divorce expert, because he needs to know this, because he needs to know which schemes he's going to recommend are shared. But it is of no real interest or use to the clients, or with the greatest respect to their solicitors. So asking true values for true values is merely of passing interest, I would suggest. And sometimes, especially in pension sharing reports where there are lots of questions being asked, it's kind of an irrelevance. You can't do anything about it, because if you're sharing one of these schemes, you're sharing its valuation, and that's what it is. It doesn't matter what it's worth on the open market. In the John Lewis example, you've only got £300,000 to share. So equality of income is the guiding principle of how pensions should be shared. I think most people understand that and have read that in places like the PAG report, etc. And if I look at version 1 of how these pensions could be shared, you will see that we have recommended that 85.5% of the husband's SIP, which, if you remember, was worth £1 million, was shared to the wife. So you can see the wife's received this down here. What it's done is generated equal incomes of 44,600. And the only issue here is that actually we can't share 85.5% of the husband's SIP unless we sell the property. Because remember, the property in the SIP was worth 400,000 of the million, and if we wanted to do an 85% share, which would only leave him with 145,000, that means that somehow the properties had to be sold. Now, there's all sorts of practical issues about selling a property in a SIP, because because where's he going to work? Where's husband going to work if you make him sell his property? And often that property might well be co-owned with a few directors who own a portion of that property in their own pensions. So it's not really very practical. Not always very practical to offload that property. So we had to then think again to say, well, we can't do this version of pension sharing. We've got to think of something else. And that's something else, version 2, is we've got to leave the husband with £400,000 of a pension fund, which is the property. That means we can only take away 60%. So we now need to look at where else we can get a share from. And if you remember from a couple of slides ago, we've decided that it is the John Lewis scheme, which, although offers poor value for money, it's not as bad as the Scottish Widow scheme. So we're going to look at sharing the John Lewis scheme. And what we did there is take 69.4% of that scheme, paid it to the shared it to the wife. What you've then got is equal incomes, driving principle of pension sharing of 43,300. What is of note here, also while I'm on this slide, is you'll note that we haven't even used this valuation, the teacher's valuation. What we have used, of course, is this figure, because we needed to know what this income figure is in order to create equal incomes. But hanging around sometimes for up to 3 months for some of these schemes to wait for valuations, in this instance, would be a complete waste of time. And a pension on divorce expert should know this, so it should be able to triage a case and say, well, we actually don't need to write off to the TPS to get the valuation. We should just ask that teacher to go on their online portal and get the valuation, and that can speed things up quickly. If we look at then what we've created between, this is version 2, between version 2 and version 1, is that in version 1 on the right hand side, remember we created equality of income, 44,600, but this was impractical. We couldn't share as much of the husband's SIP as we wanted. Version 2, which is a more practical version, still created equality of income through a different share. And what you will see is, because we had to take some pension from the John Lewis scheme, which showed a poor value for money, we've reduced the equality of income from 44,600 to 43,300. That's the best we can do, the most practical thing that we can do, that creates best value. And I think the point I'm trying to get here is that rather than ask for what's fair value, you should trust the pension on divorce expert, that they will triage this and they'll know what's good value and what's poor value, and they will recommend a pension share which creates a maximum income for both parties in the most effective manner. I also want to point out, if we look on the right here, we've created equality of income, we have in both scenarios, but we haven't created equality of income. And equality of income is another irrelevance as far as we're concerned, because if you ask for equality of income, you would immediately see that you won't have created. If you ask for equality of capital, you won't create equality of income. So again, it's to our mind, it's in most cases. My caveat is in most cases is an irrelevant issue. So a bit of a summary on that section, and the summary is that valuations aren't always necessary. As I showed before, the wife had a teacher's pension scheme. We didn't need to know the value of it, and if we don't need the value of it, we don't have to chase it, and therefore it can speed things up. There is often more to the valuation than meets the eye. I've demonstrated that with guaranteed annuity rates and the John Lewis scheme. There's stuff behind it, but that's our job to spot that. And apologies to make for making this point again. If you trust the pension on divorce expert to understand the valuation nuances that are present and share the pensions in a manner that generates best outcome for both parties, that's going to get what you're asking for of a single joint expert. And I guess there's an opinion about this, but in the main, it's a red herring to ask for equality capital or asking for fair value calculations. It's not difficult for us to do it, but in our experience, it often creates more data for your clients to process than they perhaps need, and often will generate debate and discussions, or dare I say arguments, which are unhelpful because they're arguments on figures which are of little relevance to the matter in hand. If you want to discuss whether you need that or not, then in some cases we still do it because that's what we're asked to do, but talk to us about the relevance of it if you think that might help. Just nearly coming to the end now. I just want to talk about timings of this of valuations, and if this is a divorce timeline, and we've started the journey with getting a valuation of the scheme at a certain date. That's when we will do our work and so on and so forth. When you've reached an agreement and got your pension sharing order sealed, most of you will know that you should wait 28 days until you get a decree absolute, because in my terminology, the pension sharing order has a 28-day cooling off period before it becomes effective. When it does become effective, that day is deemed the transfer day. That's the transfer day, is the day that the order takes effect. So you've reached an agreement on the pension sharing order, and it's past 28 days, and you send your paperwork off to the scheme administrators, and their implementation period starts only when they've received all the information that they need. And when they start their clock, so when they've got all the paperwork they want, which might be a discharge paper or where's the money going to and all that sort of stuff, they have 4 months to implement that scheme. And importantly, in that 4-month period, the scheme will nominate a valuation day. They will say, right, this is the day we're going to revalue the CE, and they revalue it based on the benefits that existed on the transfer day. Now, this probably will answer a few questions when people say, well, what happens if I don't implement a pension for a long period of time? When they revalue it on valuation day, they revalue it and they look at the benefits that have been accrued up until the transfer day. They exclude contributions if it's a personal pension type scheme, or accrual if it's a final salary type scheme, but not growth. So they should do, and we've got a few instances where scheme administrators don't do this, even though it's in statute, so they should do it, or they have to be reminded to do it, but they should wind the clock back. There are still lots of issues with taking too much time to implement a pension share, but just to be aware that that is the timeline that on which implementation and valuations are based. So just coming to a close, a few points on speed and valuation changes, and it's just I don't want to teach you to suck eggs, but obviously, if you ask clients for their valuation statements, it often can negate us having to get them and all the time taken. And of course, most or many people have access to their pension statements from web portals, and that's an increasing thing. Just be aware, though, with clients who go off to their DB, their final salary pension fund, and ask for a CE statement, because they're allowed one of those free a year. And if they've asked for one and we want to get a refreshed and up-to-date one, there could be a charge. So a DB scheme can charge for a second valuation within 12 months. We always recommend getting a state pension forecast, which is a lot quicker than it used to be in the old BR19 days, because you can now get it online, and it's a very quick experience to do that. I mentioned before as well about DC in valuation changes, which is a question a lot of clients ask, and this is the general trend of pension funds. The black line is a FTSE, so you can ignore that, but the pension funds have obviously varied over the last 14 months. That's showing the COVID dip. But of course, if you're quick when you implement and you get out and then back in quickly, there shouldn't be too much of an issue with valuation changes. So in general, if a client says, "Oh, I don't want to look at movement pensions yet because the markets are low," well, that's a bit irrelevant, because they're going to get out of a scheme and into a scheme at a low ebb. So if that makes sense. That's a slide which we include. You're going to get copies of this. So this is all the stuff that Blue Sky can help with. That's the end of the webinar. Thank you very much for your time. We're always very keen that you tell us what you think about this webinar and any other ones that you want. The SurveyMonkey link is there, and I believe Mike is going to also drop that web link into the chat box. So be really grateful. Apparently it takes 2 minutes to do. That'd be great. And I know lots of you have done it. And thank you, by the way, for those of you who've done it in the past and left some nice comments. And a reminder that our next, our number 5 webinar is pension offsetting and the Chamber of Fears. Goodness knows why I called it that. I can only think of Harry Potter when I must have been doing that. So hope that was useful. If you think this has been useful and you want to keep in touch with Blue Sky, you can go on the website and sign up for our Professional Connection newsletter, where we regularly issue updates on this particular topic. So I'm going to pause now and just see whether there's any questions that need answering from my colleagues who've been keeping an eye on this on the chat room. So, gentlemen, are we done?
We started. Thanks, Mark, for that. We started off quietly with not too many, and then we ended up with a few. So I'll relay a few past you, and maybe we can answer a few of them. Sarah had asked, if you don't have the CETV for the teacher's pension, how would you complete the D81? I suppose, I don't know if you've got an opinion on this. So this is the age-old problem that for example, the Form E as well also asks for CETVs. It doesn't help by asking for a CETV when you've got a pension, just as Mark said, that's undervalued. The form is already aiming to try and to capitalise. To share capital on a pension, when in fact pensions are split typically on the basis of their income. So I think, Sarah, you would still try and obtain the CETV in any case.
Well, it's either that or you put not applicable or not relevant in. in my experience, there are many cases where we haven't got the valuation because it wasn't relevant, and the case has still gone through.
Yeah, I think I had a similar question. I can't see instantly where I got that one from, but there was somebody else who asked a similar question about CETVs being relevant for. Does the same thing apply to local government pensions and NHS? Mark's soundbite is the same, whatever the name of the scheme. That's for sure. David says, is not a true value and capital value important if you're considering offsetting, similar derivative of that previous point? The answer is yes. You still want to obtain it for the sake of doing it, but naturally, there's going to be an issue if you've obtained a capital value that's not fair value and you're using that as the basis of an offset. There's an issue there, isn't there?
Yeah, I think so, and this is where it can get very complicated because I'd have to do a worked example to demonstrate that it's really not that relevant. I think the main point here is if the share is going from, in my earlier example, from the husband to the wife, all we're really interested in knowing is what the DB pension payable is for the wife, not the value of that scheme. I think if I'm just repeating what Rob said, it's from our many years' experience, and we will know what are good value schemes and what are poor value schemes and which ones to share, and in most cases, even if we're doing offsetting, in my earlier example, which you will get copies of, it's still not relevant what the wife's teacher's pension was worth, even for offsetting cases.
Now Rachel's come up with a question. We're away from defined benefit here for a moment, back onto the world of SASs and SIPs. And the question raised is, in the case of a SAS where a loan has been made out of the fund, what is the correct capital value to use? How could the PODE approach this?
Well, I think you're looking at the net value. I'm trying to think of a situation we've had and how we've treated that. But my first response, I don't know what you think, Rob, but I would say no. You'd be looking at the net value because that would be like a property, isn't it? You would look at the equity in the property.
Well, one thing's for sure, if we were involved in as a PODE in a report of that nature, we would be writing to the SAS or the SIP asking for warts and all of all the positives and all the negatives of the scheme.
Yeah.
So that we could formulate a proper opinion on it.
And I think, just going back to the previous question, Rob, because my next session or our next session is on pension offsetting, I might try and do a worked example to show that even on offsetting, maybe I'll try and use a same case study, even if we're applying offsetting, it still wouldn't worry us what the value of that recipient's teacher's pension was worth. And I'll have to try and see what I can conjure up for that one.
Going right back to some of the early slides, actually, Sarah had said, are there any DB schemes where the member has no choice but to take the benefits once they've retired? For example, the armed forces. So they couldn't actually give an undertaking not to draw. I've got kind of a derivative point off of this, but I don't know if you've got anything specific to that particular dilemma.
Well, I think she's right. I think she's right. Once in some cases where you flip over you've passed retirement date, the basis of the valuation will change, because even if you don't take your benefits, they'll be accruing and waiting for you from a scheme which is now effectively being crystallized in jargon terms because you've passed retirement date. So I think in that instance she's right.
Yeah, I think the other thing on I had a case recently with the divorce was going to go through at a time where the individual had been made redundant, and that's another mitigating circumstance. He needed to draw that pension to generate an income, so they needed to disclose that to all parties and say, right, well, I'm going to have to take that one of my 5 pensions because I don't have an income stream. So I think there's always a dynamic there that you need to chat it through. But equally, I'm sure Mark and I and the rest of the Blue Sky team can think of examples where people have taken their benefits during the process of us doing a pension sharing report, and it's been sort of quite difficult for us to not think of very sinister reasons as to why that's good. But yeah, it's a dynamic point. I think it's one to be worldly of. If the person is close to retirement or could take benefits, just be aware, and if you think or fear, then get your undertaking not to draw in place. What else have I got here? Oh, Michael has asked a question. In general, is there a rule of thumb as to the rate at which CETVs decrease when the pension is in payment? I think the easy answer to that one is no.
Well, you would guess at it. I mean,
yeah.
The only way you could guess at it is to look up the longevity of that individual and do a big spreadsheet that would show that in the because I guess that's what the scheme members do. You know, if you've got a 30-year lifespan, you will diminish that on a linear basis over those 30 years. But it's back to the fact that it's up to the scheme trustees to work out their profile of how they value stuff.
Now, but the last one on my list, I don't know if any of the others have got any other points in the team, but Christine raised her hand about 2 slides in, and you had a nice flow to you at the time, Mark, so I didn't want to interrupt you. I don't know if Christine still has that hand raised. I don't know if Christine has a specific question, but either go live and speak to us live, or drop me a little note in the Q&A, and I'll pick it up either privately or on air. I'm out of questions, I think. I don't know if anybody else in the behind the scenes support team, or any of you listening, have any extra points that you'd like to pick up with the Blue Sky team. We'll keep it live for a few more minutes, I think.
Yeah. We're all good then. We're all good.
I think we're good. I think we're. I can't see any new questions.
Excellent. Well, let's if it's that's come to a natural conclusion. If everyone's all done, then thank you very much for attending, and hope to see you back on the 5th of May.
And thanks certainly for those that raised questions. It certainly keeps us keen behind the scenes here whilst Mark is doing his piece.
Lovely. Well, thanks everybody, and see you soon.
Rob, Julie thinks you may have missed her question. Yes, I think you put it into the answered bits.
What information should you be asking for in relation to a SIP in addition to the CEV, i.e. how do you know the part of the fund that consists of a property?
It's a very good point, but if you get a statement, the example I used was AJ Bell, but in all SIP payments, in all SIP payments, in all SIP statements, the property will be listed. The interesting point is that generally SIPs won't revalue that pension property, and what I mean by there is if you bought a commercial unit and put it in your pension and it was worth 200,000, they won't be regularly revaluing that commercial unit. So the thing is, when you get a SIP statement, you might well find that the property value that's quoted was a property at purchase, and it might be 10 or 15 years or whatever past that, and it would be worthwhile checking or instructing or making sure that a new valuation is instructed. So it's a good point, but within that SIP valuation statement should be all the assets that are there, but you do need to make sure that the valuations are up to date. Good. Well, I'm going to say goodbye again, and thanks everybody for attending.